Good morning and welcome to the second in Guildhall Chambers Insolvency Team's autumn series of webinars. I'm delighted this morning to be joined by Ed Husband of VWV, and over the course of the next hour or so we are going to be looking at section 127 of the Insolvency Act and all things concerning void dispositions in a corporate context. The focus of this talk is principally going to be on corporate insolvency and how the provisions of 127 apply. There will be a lot of crossover between what we discussed today and the application of section 284 of the Insolvency Act in the context of bankruptcy, but there are some subtle differences, and so it shouldn't be taken as read that everything that's said today can apply carte blanche to bankruptcy. Before we kick off, there's just a few quick items of housekeeping. Hopefully everyone would have seen all these from the slide that was on the screen a moment ago, but if I can just remind those who are observing this webinar today to make sure that your cameras and your microphones are switched off. That helps with the bandwidth, and also if you can refrain please from taking control of the slide deck, then hopefully everyone should be looking at the right slide at the right time. If there are any questions which anyone has as we go along, then please feel free to stick a message in the chat function. Alternatively, there'll be an opportunity at the end for people to raise questions either by, again, typing in the chat function or turning on their mic and asking it orally. And finally, I do just have to give the legal disclaimer, which is that nothing which we say today should be taken as representing legal advice, although hopefully the content will be of use to people involved in insolvency, both as insolvency practitioners and solicitors alike. With that all said then, I'd like to begin, I think, sensibly by having a look at the section itself. Pretty straightforward and short provision, but there's a lot of detail hidden within what is quite a short provision. And there are in particular 5 features of the section which I would like to highlight at the outset. So firstly, section 127 applies in a winding up by the court. So it's only available where you have a compulsory liquidation. And I say that at the outset because although that might seem a pretty obvious proposition, it's worth noting that there will be often cases in which you may be advising or acting for companies in distress who are considering whether it's appropriate to enter into some other form of insolvency process, be it CVA or administration or CVL. And there are a number of cases, certainly Ed and I have been involved in at least 2, Brown Bear Foods being one, Officeserve Technologies being the other, in which creditors have successfully opposed the making of administration orders on the basis that if the company entered into administration rather than winding up, where there was a winding up petition extant, the company would lose the benefit of being able to rely upon section 127, and that would have been a real tangible benefit to the creditors because the net effect was an ability to recover dispositions which otherwise couldn't readily be recovered. So I just flagged that at the outset because it's worth considering in that particular context. Secondly, what the section does is applies to any disposition of the company's property, and I'll come on in a moment to look at what that means, but note that the language is different from, for example, the word used in the context of section 238, which is transaction. It also applies to any transfer of shares or alteration in the status of the company's members, although in practice it's rare to have cases where that arises. It applies only to dispositions made after the commencement of the winding up, and again I'll come on in a moment to look at precisely what that means. And so where you have a disposition which ticks those boxes, it's a disposition of the company's property and it's made after the commencement of winding up, then it is by the section void unless the court otherwise orders. And so there is a jurisdiction on the part of the court to make an order both prospectively and retrospectively, validating what would otherwise be a void disposition. And Ed will come on to consider what exactly that means in due course. Sticking a broad high-level overview at the moment, I just want to have a quick look at the policy underpinning section 127 because it's useful to consider how this particular provision fits into the broad statutory scheme. And as you'll see from the slide, section 127 and the invalidation of dispositions of a company's assets was said by Mr. Justice Lightman in the case of Cooten's stock to be part of the statutory scheme designed to prevent the directors of a company, when liquidation is imminent, from disposing of the company's assets to the prejudice of its creditors, and to preserve those assets for the benefit of the general body of creditors. And one can see that there is a timeline when it comes to the life of a company which is insolvent, and at any given time the company could be at any place along that timeline. Prior to the point when a winding up petition is presented, then there's what we sometimes refer to as the twilight zone, where if during that period the company is insolvent and it enters into transactions which either reduce the value of its assets because it gives away more than it receives, or which prefers one creditor over the general body, then the office holder duly appointed can subsequently seek to unwind that, but obviously the burden is on them to demonstrate both solvency, although it may be a case in which certain statutory presumptions arise, and that there was necessarily some element of undervalue or preference. Once the winding up petition is presented, the company is moving closer towards potential formal insolvency, and so section 127 in essence flips the burden, so that therefore any disposition of property entered into by the company, irrespective of whether or not it was for full value or whether or not it was, could be said to be a preference, is treated as void. It's then for the beneficiary of the disposition, usually the recipient, to try and persuade the court that it's appropriate for that transaction nevertheless to be blessed. And the whole underpinning purpose behind the section is allied to these two core principles of insolvency law, with which I'm sure everyone will be familiar, which is the anti-deprivation principle. That's the idea that the company's assets should be available for its creditors as at the date of liquidation. And the pari passu principle, that's to say that creditors in a liquidation should be treated on an equal basis. I want to dwell very briefly next on the commencement of winding up, because as we've seen, section 127 only applies to dispositions of property that are made after the commencement of winding up. And as I'm sure everyone will be aware, ordinarily under the Insolvency Act, specifically section 129 subsection 2, a compulsory winding up is deemed to commence at the time when the winding up petition is presented. This means that in effect you have a relation back period, so that any dispositions of property between the presentation of the petition and the making of the winding up order are within the ambit of section 127. But the only reason why I flag this provision at this stage is that one has to be a little bit cautious at the moment because of the temporary measures that have been put in place to fight the coronavirus pandemic, and specifically paragraph 9 of Schedule 10 of the new Corporate Insolvency and Governance Act 2020 provides that where a creditor's petition is presented on or after the 27th of April 2020, which is the date from which the new act is deemed to have taken effect, the commencement of winding up is deemed to occur not when the petition is presented, but on the later date when the winding up order is made. What that means in practice is that for cases where the petition was presented after that date, there will be no application of section 127. And so everything that we come on to say now will be treated as applying only to those cases, historic cases involving petitions presented before that date, or hopefully future cases once we're through the other side of the pandemic, and presumably Parliament will then revert to the position of 127 kicking in on presentation of petition. Next thing I want to consider is what exactly does disposition mean? And perhaps unhelpfully, there is no statutory definition of disposition found within the Insolvency Act. And as I said a moment earlier, it is a different word from transaction, and so therefore it must mean something slightly different from transaction. Hopefully there is some guidance both in academic commentary and in some of the case law. And starting with the commentary, I always find that one of the best places to go when considering transaction avoidance claims in insolvency is a very slim book written by Adrian Walters. Only one edition was ever published. It's now about 25 years old, so a lot of the law is now somewhat out of date, but the underlying principles within it are very good. And he noted within that, the book itself is called Armour and Bennett, and Adrian Walters, who edited the relevant chapter, noted that on a strict reading of the word disposition, a mere shift in value will not usually be caught unless it's accompanied by the transfer of some identifiable property right from the company to another party. But there are cases where you get value subtracted from the company, and then it's the value which is transferred across to the other party rather than a specific defined asset. And he suggested that the court may be persuaded to adopt a more purposive construction in cases such as that, on the basis that the counterparty is enriched at the expense of the insolvency estate. And this really hits the nail on the head, and this theme is picked up by Professor Good in his seminal Principles of Corporate Insolvency Law, in which he suggests that the word disposition needs to be given a wide meaning if the purpose of section 127 is to be achieved. And so he suggested that disposition must include not only a transfer of a tangible asset, but any act which, in reducing or extinguishing the company's rights in an asset, transfers value to another person. And some examples we can see of a disposition that would fall within that definition is the grant of a lien, because essentially that encumbers the company's assets and the lien holder obtains a benefit to the same extent. The surrender by the company of a lease of which it's the landlord. By giving up that lease, it's given up the right to receive rent, and correspondingly the tenant has been discharged of any liability to make future payments. So no physical transfer of an asset, but clearly a transfer of value. The giving up of contractual rights, which I'll come on to look at in a minute, and the application of set-off. However, he went on to say that disposition must lead in a real, not a merely technical sense, to a transfer of value. So he gave the example of the extinguishment of a chosen action on the collection of a debt. So clearly, if the company is owed the sum of £100 by its director, and after the presentation of the petition, the director repays the company, then strictly speaking, the asset which the company had before that payment, the book debt, no longer exists, and the director has received a benefit from the payment because he's been released from his obligation to pay. But of course, it would be nonsense to suggest that that's a disposition of property, because the company receives the physical money in cash. So that is the landscape as set out by the academics. I want to then see how that applies to different types of disposition, and I use the word loosely, that may or may not be caught by section 127. And I want to start with straightforward and most easiest example of payments of money. And I'm going to start with looking at payments made to the company. So payments of money into a company's bank account after the presentation of a winding up petition. Now, slightly counterintuitively, those payments constitute dispositions of the company's property. And one might think that's slightly odd. Where the company's being paid, how can they be a disposal of the company's property? And the answer is because a bank account is simply a relationship of debt and credit between the bank's customer and the bank. If a bank account is in credit, what that means is the customer has lent the bank money. If it's in debit, then the customer has borrowed money from the bank. So if money is paid into a company's bank account, then the net effect is that the company is either lending the monies to the bank, or it is using it to repay what it owes to the bank. But this is all a bit theoretical, unless the company is either insolvent, so the bank is either insolvent, or the company's bank account is overdrawn. And the reason for that is obviously, although strictly speaking, paying money into a company's bank account is a disposition of the company's property, if the bank is solvent and the company's account is in credit, then the liquidator can simply ask the bank to transfer the balance to them. So no harm, no foul. But it's worth noting, because if you have a case in which a company's bank account was overdrawn, and money has been paid into it by creditors, by debtors of the company after the presentation of the petition, those transactions can be set aside against the bank because the effect has been to reduce the bank's liability, or the liability owed to the bank, should I say, and then the net effect is that the bank is put in a better position than other creditors. Equally, in the slightly unusual factual scenario where your bank is itself insolvent, it's useful for the transactions payments into an accounting credit to be void, because then the monies can be recouped out of the insolvency of the bank. Importantly, though, for the purposes of Section 127, although clearly a payment out of a company's bank account is a disposition, it was made clear by the Court of Appeal in the Hollycourt case that it's a disposition not in favour of the bank, but rather in favour of the ultimate recipient of the monies. And that makes logical sense. If a company has a bank account in credit and it transfers money from that into the account of a third party, although technically it might be said that the bank is the one that's received the benefit of the disposition because the amount that the bank owes to the company has gone down, in reality, if we're looking at tracing value, the value ends up in the hands of the recipient of the payment. The next thing I want to look at is settlement of claims, a slightly unusual one. And this was an issue that arose in the case that Ed and I were involved with, called Officeserve Technologies. And in that case, the company had entered into a settlement agreement with one of its directors of potential misfeasance claims against the director after the presentation of a winding up petition. And the court was required to grapple with the question of whether, by entering into the settlement agreement, the company had in some way disposed of property. And His Honour Judge Matthews started with the obvious proposition that, as we've seen, a physical transfer of tangible property is clearly caught by the section. And he went on to say that a transfer of intangible property is also caught. So, for example, the assignment of a book debt by the company to a third party would be void. He noted that the mischief which the section is intended to avoid, as we saw when we were looking at Section 127 itself and the comments of Mr. Justice Lightman and Coutts and Stock, is the same, where what has happened is not that a debt owed to the company has been transferred to someone, but it's simply been released, because the net effect of that is to reduce the company's assets, which would otherwise be available to meet its debts. And what Judge Matthews said was that the destruction or reduction in value of a property right belonging to the company, which causes an immediate and equivalent accrual in value to another person, clearly falls within the mischief that Section 127 is intended to avoid. And therefore, the release of contractual rights by a creditor company in favour of a debtor amounts to a disposition. And he said that you don't need to be able to demonstrate that property passes from the hands of the company to the third-party recipient in order for it to amount to a disposition. All you need to show is that there's some identifiable property of the company, in this case, the cause of action it had against its director, which by some act having legal consequences ceases to be in the ownership of the company. In this case, the company releases the claim by the settlement agreement and no longer has the cause of action. And the value accrues to some other person. In the Officeserve case, the value accrued to the director who'd been released from any claims because he no longer had a potential liability to the company. This is all in keeping with what Professors Waters and Good suggested, as we saw earlier. And examples that Judge Matthews gave were, much like Professor Good had suggested, surrenders of leases where the company is the landlord, releases of debts, and cancellation of charges held by the company. So all of those caught by Section 127. Slightly different is the position where what has happened is a transfer by the company, not of an asset which is legally owned by it, but rather the transfer by a trustee of property held on trust by the company. In Akers and Samba, the Supreme Court rather, decided that where a trustee holds property on trust for a company, the beneficiary company then has a winding up petition presented against it. and after the presentation of the petition, the trustee transfers the property to a third party, that is not a disposition for the purposes of Section 127. And at first blush, that may seem a very strange decision and somewhat counterintuitive. But when one scrutinises the reasoning of the Supreme Court, it is easy to understand how they reached that conclusion, even if at first instance it may appear surprising. So what happens in the Akers and Samba case, much as I've described, is that you have assets, in this case shares, that are held by the trustee on trust for the company which is subject to the petition. Those shares are transferred to a third party, and the effect of the transfer is that the company's beneficial interest in the shares is essentially destroyed. But what the Supreme Court said was, well, the beneficial interest isn't destroyed because of the transfer. As a matter of legal analysis, what happens is all that the trustee does is transfers the bare legal title to the asset to the third party who acquires it. That in and of itself doesn't involve any disposition of the company's property. Now, it may be that as a matter of law, when the trustee transfers the property to the third party, the legal effect of the transfer is that the beneficial interest is destroyed. It may not. It depends on what the legal position is. And so, to give a prime example of this, to put some flesh on these bones, if the asset that we're talking about is real property, so the company owns a piece of real property, or rather, sorry, the company's the beneficial owner of real property, it's held on trust for it. If the trustee purports to sell the property to a third party purchaser, then the beneficial interest will remain in the property unless it's overreached, and it will only be overreached if the purchaser deals with either two trustees or a trust corporation. So if the property is only held by one trustee, then as a matter of law, the beneficial interest will remain. If it's two trustees, the beneficial interest will be overreached. The beneficiary of the property will not be left with no remedies because they'll be able to sue the trustee for breach of trust. But it's the operation of law that means that their beneficial interest no longer exists. Now, that's all jolly interesting legal discourse, but the practical consequence of that is simply this. In a case where a company which has entered liquidation was the beneficial owner of assets, and those assets were transferred by a trustee post-petition, you won't be able to look to Section 127, but you may well have other avenues of recovery to attempt to get in that property, either by way of a tracing claim, breach of trust, dishonest assistance, knowing receipt, and the like. But you have to look to trust law, not to Section 127 and restitutionary law, which we'll come to look at in a bit. That's been quite a lot for me. I'd like to hand over to Ed now, who's going to spend some time looking at the next substantial topic we want to cover, which is validation orders.
Thank you, Simon. Good morning, everyone. So, as Simon has said, he's looked at this kind of statutory framework of Section 127, and critically, we now understand that a disposition made between the presentation of the winding up petition and the hearing date is void, but critically, it is possible to apply to court effectively to validate that, and that's what I'm going to look at. And I'm going to look at two particular aspects. One, the practical nature of that kind of application and what you need to do, and then after that, some recent case law and the evolving nature of the case law that a court will consider when looking at applications of that nature. So the starting point for any kind of application for a validation order is found in the Insolvency Proceedings Practice Direction. We've set out on the slide there subparagraph 9.11.7, but more generally, paragraph 9.11 relates to applications generally. So the starting point is who can make an application. The case of Re Argentum Reductions made it clear that any interested party can apply for validation. So that might include a creditor, an employee, a recipient of the payment, or even a director, as we had in the Officeserve case. So When making an application, notice needs to be given to the petitioning creditor, any person entitled to receive a copy of the petition, any creditor who has given notice of their intention to appear on the hearing, and equally any creditor who has been substituted as a petitioner. You're required to give 14 days notice of such an application, and elsewhere in the practice direction there's some very helpful guidance, I think, on what you need to provide in your application. So critically, the witness statement, typically if it's being made on behalf of the company, should be made by a director who is intimately acquainted with the company's affairs and financial circumstances. And, if appropriate, the application should be supported by a witness statement from the company accountant. So, subparagraph 9.11.4 also sets out what should be included as a minimum in any witness evidence, and that would include the circumstances leading to the presentation of the petition, how the company became aware of it, whether the petition debt is admitted or disputed. Critically, full details of the company's financial position, including details of its assets and liabilities, a detailed cash flow forecast, a profit and loss projection, and the reasons relied on in support of the need for the dispositions and why they need to be validated. So, as we can see from that, this is an application that's not to be made lightly. It needs an awful lot of work, and as we'll come on to, it's not a step that the court will take lightly to validate such an application. The balancing exercise that the court makes in deciding whether to make such an order, we'll come on to some of the case law in a moment, but the critical point is summarised in the slide on screen at the moment. So the court will typically make a validation order if there's evidence that the company is solvent. That's a case called Re, Burton and Deakin from 1977, or alternatively, if the transaction or series of transactions in respect of the order is sought will be beneficial or will not prejudice the interests of all unsecured creditors as a class. So we'll come on to that when we look at some of the case law and how it's evolved. So for most of the time that I've practiced, the main case that we always went to when we were considering whether to make a validation order or whether to oppose one was Gray's Inn Construction. So it's a 1980 Court of Appeal case. The facts of that case were fairly common. So it related to various payments made into and out of the company's bank account. Critically, those payments were made both before the advertisement of the petition and after. So that was something that grappled with. I think the decision of Lord Justice Berkeley in this case is quite hard to follow in some sense of the logic of it. So if you read the judgment, the first half of the judgment, the judge goes to great lengths to explain the importance of maintaining the pari passu principle and underlining the need to maintain that. He did give a couple of examples of when the court might validate a particular transaction. The examples he gave were if, for example, the company had the opportunity post-petition to dispose of some piece of property at an exceptionally good price. Equally, the court might validate a particular contract or project to enable it to carry on operating its business generally in the ordinary course with the view to a future sale as a going concern. But in that case, the judge did make it clear that the greater the number of transactions or the further into the future the company would be looking to trade, the more evidence you would need. But critically, having set the scene in that sense, and also explained that generally you would need special circumstances to make an order, the judge went on to say that it was the prevailing practice of the court at the time that where the parties are unaware the petition has been presented and payments are being made in the normal course of business, it was the court's practice to validate such a transaction. So that was the prevailing practice for many years until we get to the case of Express Electrical and Beavis, another Court of Appeal case in 2016. So again, in that case, it was a fairly typical scenario. A supplier had supplied to a particular company that had a petition down. There was no evidence that the company knew of the petition itself, and the critical payment that was made was a £30,000 payment made before the advertisement. So in that situation, if we followed the kind of rule set down in grazing construction, that was a payment made without knowledge, seemingly in the ordinary course of business on the face of it. However, in that case, Lord Justice Sales, giving the leading decision, was very critical in some senses of the prevailing law as it stood from Gray's Inn. So he went through the transaction itself. He was quite critical of the evidence that had been provided by the applicant as to what the benefit of the payment was. He highlighted, for example, that it didn't seem to be in the normal course of business. The payment had been made well within the payment terms. There was no evidence that there was anything particularly advantageous for creditors generally. It wasn't a particularly profitable contract, for example. So in that scenario, Lord Justice Sales looked at the prevailing rule in Gray's Inn, and what he said was he couldn't understand why in that situation the court had accepted as a bold proposition that the disposition carried out in good faith in the ordinary course of business should be validated. And the judge explained that in that kind of case, irrespective of knowledge, validation could well prejudice the interests of the general body of unsecured creditors. So knowledge wasn't the relevant factor in that. So the judge went on to explain that he didn't see that the prevailing rule from Gray's Inn was intended to be a binding rule. So critically, a balance needed to be struck, and there needed to be particular evidence of a special circumstance which would show that the disposition in question was or has been for the benefit of the general body of unsecured creditors. And we'll come on in a moment to look at prospective and retrospective cases, but that was a significant shift in the kind of prevailing approach that the court took to those kind of applications. So critically, that's now reflected, I think, in the practice direction, which does make it very clear that the court needs to be persuaded that the particular transaction that's being validated, or series of transactions, needs to be for the general benefit of unsecured creditors. So, having not had many cases on point for several years, we then get another one in 2019, which is MK. So this is a case involving 3 stores which operated under the NISA brand. So in that case, the liquidators sought repayment of certain direct debit payments that had gone to NISA in return for them supplying those stores post-petition. Now again, the court was very critical in that case of the evidence supplied by NISA, and a gentleman called Mr. Chapman came under some particular criticism in that case for his fairly laissez-faire approach to checking on whether or not a petition was down. There was evidence to show that NISA did have a monitoring process, and it may well have been the case that they were aware of the petition. But critically in that case, the judge made a number of findings which again really supported the position as set out in Express Electrical. So the judge made it very clear that it's for the applicant to show the circumstances that make a validation order appropriate. Now, practically that can be quite difficult if you're not the company. So in circumstances where you need to demonstrate that it's for the benefit of the general body of creditors, as a third-party applicant, you might not have that relevant information. So in that scenario, the court did say that in principle, it was willing to make certain findings based on inference, but it needed to be satisfied on all of the facts. It wasn't in this case, and it refused to make the validation order, and it emphasised that it wasn't to be automatically assumed that transactions in the ordinary course of business or even sale of assets at full value are necessarily for the benefit of creditors. So in this case, what was examined was whether particular payments, not only were they made in the ordinary course of business, but when the payments were received, one, were they sold at a profit, with the profit from those sales, so day-to-day transactions of a general convenience store, it was critical that those payments went into the company's account, and critically that they also remained in the possession of the company at the date of the winding up, such that they would benefit the general body of unsecured creditors. So again, it shows that particularly if you're making the application on behalf of a third party recipient, it's increasingly difficult, I think, to demonstrate that benefit to the general body of unsecured creditors. The next case I was going to touch on, just jumping back a couple of years, was a case that Simon's already mentioned, which is Officeserve. So what has been touched on in various of the cases, going back to the Gray's Inn case, was validation orders can either be made in advance or after the event, so after the transaction has been made. And the courts in various of the cases we've mentioned had looked at whether, when assessing those transactions retrospectively, it was appropriate to look at the facts at the time of the transaction or to look at them with the benefit of hindsight. Now, in the Officeserve case that Simon's already touched on, and I note just in passing that there are 3 cases on Officeserve relating to different factors surrounding Section 127. This relates to a case about validating the transaction in hindsight. So this is the settlement agreement case that Simon's already touched upon. But in that case, His Honour Judge Matthews here in Bristol made it clear that he could see no reason why it wasn't appropriate for retrospective validation cases to take into account all of the relevant events that had occurred. So in short, hindsight could be provided, because as a matter of policy, if a party was entering into a transaction without getting a validation order in advance, then that party took the risk for that transaction. So if it turned out well, the party would benefit from that. If it didn't, and it wasn't for the general body of creditors, it was right in that circumstance that the court would take into account those factors, and if it hadn't worked out for the benefit of creditors, refuse to validate it. So that was Officeserve Technologies, and having had several cases, we now have another one very recently in the last week or so. I think literally last Thursday, this was reported. We don't have a full judgment yet, but this is a judgment relating to the sad demise of Macclesfield Town. So in this case, Macclesfield had been struggling for several months. A winding up petition had been presented in January 2019. There'd been some toing and froing. It was originally an HMRC petition, but then someone else was substituted and HMRC was substituted back in. So there was a long period in which the petition was down, and during the course of that, the court did make various validation orders in relation to particular payments to creditors. So we don't know the detail of that, but I assume they may have been made in advance of those transactions being entered into. But the application that has been reported in the last week or so related to a debenture and related charge over the football club's property entered into on behalf of an investor, and that was made, or the application was made retrospectively. Now, in balancing the various factors in deciding whether or not to make that order, ICC Judge Nick Briggs, who's formerly of Guildhall and also VWV, took into account various factors. Now, as I said, we don't have the judgment in detail, but what he seemed to conclude in my view, marginally deciding to make the order, it was relevant that the company didn't seem to be heavily loss-making, and in making the secured loan, it was clear that the object was to try and get through the season, which was then subsequently greatly impacted by COVID. So it seems like in this case, Judge Briggs decided to make the order, but that seems to have been, I think it's quite difficult on the facts that we have at the moment to see on what basis he made that, because it does seem to be quite finely balanced. It seems to reflect the fact that there were, the nature of COVID was made the kind of decision making quite difficult, and it was certainly unforeseen the impact that would have. So it appears that Nick Briggs made that order, but we wait with interest just to see if we are going to get a full judgment to see that in a bit more detail. So
I think on that, Ed, I think
yeah.
possibly a critical factor was that we should say all we have at the moment is a Lawtel summary of the case. I did check with Chief ICC Judge Briggs, and it was an extemporary judgment, so we'll have to await a transcript of it. But it strikes me, just on the basis of what we have so far, that what may have been another critical factor was that, slightly unusually in this case, you had the company applying for and obtaining prospective validation orders around the time, in fact, after the transaction which was retrospectively sought to be validated. And so I suppose it's a pretty easy submission to make to a judge, which is, well, put yourself in the shoes of what would have happened if this had been made prospectively. We know, as a matter of fact, this would have been granted because we know that the company could demonstrate it was sufficiently solvent and or that it was appropriate for it to continue trading at that point in time.
Yeah.
But the interesting question, I think, remains to be seen when you compare it with the MKG case, and the benefit of hindsight is, well, there's a slight tension there, because in MKG, you with a short-term view, you could say that each individual payment by the company to NISA for supplies was of an immediate benefit, in the sense of if they had some goods come in and they sold them at a profit, then that transaction viewed in isolation could be seen to be beneficial. But the court took a wider view of, ultimately, this was an unsuccessful company. Contrast it here with, you can say, well, we can see that at the time it was beneficial to carry on trading, but we know that the company fell over ultimately, even though we know it fell over for different reasons. A judge may well have formed a different view and said, in light of MKG, actually, unfortunately, because you waited so long to seek validation, you have to take the chips where they fall. Yeah. And if there's any complaint about that, you should have gone and got a prospective order. Alternatively, you should have come to court sooner. But as we say, we simply don't know at this stage because we don't have a full transcript.
I think the other thing that comes across from it, Simon, is this appears to be a case where largely those involved acted conscientiously. So I think there's a reference in the short note that we have to, they did have a cash flow forecast, but then certain payments didn't eventuate. So I think sponsor money didn't come through and they needed to make this short-term loan at very short notice. So whether that's a relevant factor, I don't know.
And again, obviously, this is money coming into the company. The thing they forgot to validate was that it was a secured loan.
Yeah.
So in some sense, there was clearly no depletion in the company's net asset position, because in fact it receives £120,000 of extra cash, and it just encumbers some assets. And if you look at Mr. Justice Zaccaroli's decision in the Burnham Holdings case, it supports the view that actually a grant of a debenture isn't a transaction and undervalue, because the company parts with nothing of value.
Yeah.
Then again, it's a really fairly easy submission to say this will have no detriment to the creditors, and they'd be getting a bit of a windfall if, having received a £120,000 loan, that money was now free to pay to the other creditors at that point in time.
Great. Okay. Thanks, Simon. That was all I was going to say, Mackleton. So we've looked at validation orders. I was just going to come on to say a few short words on what you might do when attempting to recover void dispositions and the nature of that application. So we have some practical experience of this on another aspect of Officeserve. So in that case, having dealt with the kind of preliminary issue validation or non-validation of the settlement agreement that Simon touched on, we then had to, and the liquidators had to deal with a number of payments that had been made over a prolonged period between petition and hearing, and that had been prolonged because there had been a couple of adjournments. So we had an unusually long period in which the company Officeserve basically continued trading as if the petition hadn't been down. So just to put this into context, the opening lines of the first judgment we obtained in Officeserve, the judge in that case noted that at the time the company was spending in the region of £450,000 a month in an attempt to achieve an annual turnover of £52,000. Now that kind of pattern of overspending continued, notwithstanding the petition. So when we come to making an application to try and recover those payments, the court, well, you might have seen from section 127, the first slide that Simon posted, that although it's clear that those dispositions between petition and hearing are void unless validated, the court doesn't actually say what the remedy, if you like, for those void dispositions are. So we kind of, in a practical sense, we looked at that in one of the Officeserve cases, and Officeserve against Annabel is the case cited in that slide. Although Annabel's is cited, there were, at the time we issued the application, 43 respondents to the application. And what I was just going to talk through is some of the practical ways that we addressed that. So in the ordinary course, we had collected in, prior to issuing that application, all of the larger debts. So monies due from the landlord, monies that had been paid to the landlord post-petition, and we were left with a range of debts anywhere between £1,000 and about £10,000. So in the ordinary course, it wouldn't have been economic to pursue those on an individual basis. So what we were able to do was issue one application against all of those respondents with one supporting witness statement dealing with our correspondence with those parties and what we had attempted to do to recover those. So obviously that makes it a much more manageable proposition, both in terms of cost and in kind of marshalling the evidence. So although we ended up, as the reported judgment makes clear, going back to the court on 2 or 3 occasions to deal with various issues that arose in terms of basically respondents raising issues, often informally by email direct to the judge, ultimately it meant that we were able to do this in a very pragmatic way. And in ultimately making the order for all of those parties to make repayment, the other thing that the judge grappled with was how to deal with the costs of that kind of application. So in ordering all of the parties to pay their costs, or to pay the costs of the application, the judge basically divided those equally between all 16 respondents who remained at the time of the final hearing. So rather than pro-ratering them according to the debt that was owed, the judge thought that was an appropriate and proportionate way to do it. So Simon, I think you're going to come on. That's the kind of practical side of how you might recover some of those dispositions. I think you were going to come on to some of the potential defences that were raised in that and in other cases.
Yes, thanks, Ed. So the underlying principles that come out of the Officeserve judgment, as Ed said, the statute itself is silent as to what the right of recovery is. So whereas, for example, with transactions at an undervalue or preferences 423, there are specific provisions in the Act that say the court may, on the application of the liquidator, do X, Y, and Z. All section 127 tells us is that these transactions are void, but doesn't tell us how we go about getting them in. And it's well settled, based on a long line of case law, that you then have to the general law to work out what your right of recovery is. And the point that Judge Matthews made in the Officeserve case is that it's all well and good looking to the general law, but you have to start by working out what the disposition involves to know what law to look to, if I put it that way. So there's a distinction between, if your void disposition is the transfer of a property right. So, for example, the company owns a car and it gives the car to someone else. Well, then your claim is a tort claim for return of possession. because the physical asset that belongs to the company is in someone else's hands. The disposition is void, so title to the asset doesn't pass, and you then simply look to them saying, you have my goods, please hand them over to me, you have no right to them. But most commonly, we'll be looking at cases where the disposition is payment of money. And because money, or certainly the payment of money, is an intangible concept, because usually we're talking about the transfer of value in a bank account rather than handing over physical cash. The starting point is that the claim's not a tort claim, it's a claim in what we now call unjust enrichment. And a lot of the earlier cases, before we got to Officeserve, said, well, it's a restitutionary claim, but didn't quite make clear what the term restitutionary was intended to mean in that context. And what Judge Matthews said was, well, restitution just means restoring property, but it doesn't really tell you any more than that. I mean, that's the aim of the recovery mechanism. In principle, what you will do is bring a claim in an unjust enrichment, so that founds your cause of action. But the unjust enrichment claim itself has a slightly different character to an ordinary unjust enrichment claim, which doesn't involve insolvency. And it's difficult to put that slightly strange concept in more concrete terms or in less legalistic language. But I hope I can make the point good by looking at the defences that the judge said are available, because that informs how I think he intended to suggest that it didn't have all the features of unjust enrichment. I think the headline point is that the company brings a claim against someone who's received the money. The company says, I'm claiming for unjust enrichment. The defendant then seeks to defend it. Certain defences that would otherwise be available to them if this wasn't an insolvency wouldn't. So the first defence that's usually available to an unjust enrichment claim is a defence of good faith or value. So someone has received an enrichment at the expense of the claimant, and the defendant says, yes, but I acted in good faith and I gave value for what I've got, so there can't be any unjust enrichment. And Judge Matthews made the point that that defence can't possibly be available where the claim arises out of a void disposition. Because otherwise, if you think about it, that would mean that where the disposition is payment for goods supplied, for example, you can't get a validation order, it's void, but someone could simply avoid having to pay it by saying, yeah, but I gave value. So obviously that defence can't be available. The most common defence, or most familiar defence, should I say, to an unjust enrichment claim is that of change of position, good faith change of position. So that's where someone says, well, I've received an enrichment, it was unjust for me to receive it, but since then, in good faith, I have acted in such a way that my position is so changed that it would be unfair for me to, or unjust for me to have to now give back what I've had, because essentially I no longer have it. And so, to put some flesh on the bones, in general unjust enrichment claims, if someone receives money and they use it to pay off an existing debt, there's no change of position there, because all that's happened is instead of owing money to Peter, they now owe it to Paul. But if they receive the money, they think they're entitled to it, they don't realise they're not, and they decide to use it to go on a round the world cruise, then having done that, they no longer have that money. The only reason why they spent the money on the round the world cruise was because they thought they were entitled to this extra lump of money. It would now be unfair to say to them, actually, you should never have had that money and you're going to have to pay it back out of your own pocket, because they end up in a worse position. And it's all about doing justice as between competing interests and to work restitution between the parties. But in an insolvency case, Judge Matthews made the point that the circumstances in which, let me start again. He said it's theoretically available, but on the facts of the case of Officeserve, he wasn't prepared to find that the defence was made out. But in the MKG case that Ed touched upon, Judge Cook came on to say, well, it might theoretically be available, but it's very difficult to think of a circumstance in which the court would decide you're not entitled to a validation order, because although you may well have changed your position, this is a disposition that was not to the benefit of the creditors. And so therefore you don't get into the special circumstances exception for a validation order. But nevertheless, we're going to allow you a change of position defence. So really, that effectively has started to sound the death knell for the idea that there may be a change of position defence available. And the final hammer in the coffin may well have come from a decision of the Privy Council in a case called Scandinaviska and Conway. And that was you may recall that a few years back, and I'm going back about probably 8 or 9 years now, Mr. Justice Sales, as he then was, now Lord Sales, in a couple of cases, suggested that where you've got a TUV or preference claim, although the statute does not provide a defence to someone who has changed their position, because it's a sort of restitutionary type claim, there should, as a matter of common law, be a change of position defence available. And I've always thought that decision was wrong, because Parliament appears to have drawn the line. It understands that where you've got a transaction at undervalue or a preference, you've got to balance the interest of the creditors as a whole as against the person who's been the recipient of the undervalued transaction or the preference. And it seems strange if they can wriggle off the hook by saying, well, although this transaction was to my benefit to the detriment of creditors as a whole, since then my position's changed and I shouldn't have to give back. In the Privy Council decision in Conway, the Privy Council said, well, that's wrong as far as preference and TUV claims go. There is no statutory defence, and there's no common law defence of change of position. They didn't need to decide whether or not Officeserve was right that 127, which is of course does not have a statutory cause of action, and you fall back on general law, would enable a change of position defence to arise. They simply noted in passing they didn't need to consider it. But some academics think that in light of the Conway decision, change of position can't be available for 127 claims either. Again, a lot of this is very arid. It's very very academical, theoretical, very interesting to black letter lawyers. But in terms of practical commercial consequences of it, the headline point is it's extremely, extremely unlikely that someone would persuade a court that having received a void disposition and not being able to get a validation order, they could still get out of repaying, relying on the change of position defence. I'll skip over very briefly the defence of estoppel by representation. This is, again, another interesting theoretical defence, and I can maybe just summarise it in this way. The law of restitution has developed piecemeal in case law over the course of the last probably 30 years, really. Before a defence of change of position was recognised, there was an old case called Avon County Council and Howlett, where the court said that you might be entitled to a defence called estoppel by representation, which is basically someone receives a payment of monies, they mistakenly believe that they're entitled to them. The person who paid the monies is treated as having represented that the defendant was entitled to the monies, and is then stopped from requiring them to repay it in circumstances where they've acted to their detriment in reliance on that representation. And the significance of the estoppel by representation defence is that, unlike change of position, which only applies to the extent you've changed your position, with estoppel by representation, if you change your position a little bit, then you are potentially able to avoid having to pay the whole lot. So in Avon County Council and Howlett, basically a teacher was paid too much sick pay. He used some of it to purchase a motorbike, I think it was, and he was able to successfully argue, well, I shouldn't have to pay back any of it because I've changed my position in respect of some of it. There's the later case on the slide of Soma International, where they've suggested there's actually an exception to that principle, and that estoppel by representation may apply in a similar way to change of position. Again, the practical consequence of this is, again, Matthews in Officeserve said this is a defence that might be available, but then he promptly shut down any suggestion that it actually would ever arise in an insolvency context, because he said that a defendant has to show both that there's a representation that the payment's not a void disposition, and the problem with that is that that couldn't amount to a representation because you can't contract out a statute. So again, all of this is all a bit airy-fairy. Headline point, it's a defence that's available to some restitution claims, almost certainly not going to be available to insolvency context claim to recover a void disposition. That brings me on to the one defence which I think probably will be of relevance in the context of 127. That's the defence of ministerial receipt. I've put on the slide a quote from Goff and Jones which summarises how the defence applies in the non-insolvency context, which is, in essence, if money's paid to a defendant and his receipt of it was in the capacity of agent, not as principal, and he immediately hands the money over to the principal, then the court will not require him to have to pay the money back, or her, as the case may be, or it, in fact. It will instead require the principal. So in rough and ready terms, you often find cases where the company makes payment to A, the liquidator says to A, that's a void disposition, and A says, well, here's a copy of my bank statement. You'll see that it was always intended I would pass this on to B. That's exactly what I did. So B's the person that you have to sue, not me. And Rebecca Parry's book on transaction avoidance, in the passage I've set out on the slides, confirms the view that I think most judges would take, and there's some case law to underpin this, that's got to be right in an insolvency context. You're going after the person who actually got the benefit of the disposition, not simply someone who was a passive conduit through which money's passed. And that's in keeping with the position on bank accounts, where the bank is not the one that has to repay the monies, it's the person who gets the money in their hands. I'm conscious that takes us up to 10 o'clock. If you indulge us for 5 more minutes, there was one last matter that we wanted to touch upon very briefly, which I think it is worth considering, which is the interplay between misfeasance claims under section 212 of the Insolvency Act and claims against recipients of void dispositions under section 127. And I think, Ed, you were going to briefly touch upon the interplay between those two.
Yes. So in the limited time available, it was really just a reminder that we've obviously been looking at both the recipients and paying parties, but critically, there will invariably, I think, be a misfeasance claim, a breach of duty claim against the director who authorises or allows those payments to go out without giving due consideration to whether they should be validated. So very commonly, we might have a situation where obviously because the petition is down, the duty to creditors will be engaged. So, you know, by reference to kind of Sequana and other cases. So clearly, remember that if you cannot recover against the recipients, there will very commonly be a claim against the directors who allowed that payment to be made. Now, in terms of the practical point to take out of that, you're going to have a situation, as we did in Officeserve, where you might have concurrent claims. So you're pursuing the recipients, as we were, and also bringing breach of duty claims against the directors. So some thought needs to be given to the interplay between those two things. So in our case, we had the section 127 claims against the various recipients. And at one stage, because the claims against the directors were fairly well advanced, we got an adjournment of the section 127 claims to allow settlement discussions to carry on against the directors, because that's related to the amount of potential damages that would be awarded. And equally, I think Simon's going to come on and explain one of the critical things that you really need to be wary of is if you are doing things in a particular order, giving careful consideration to how you settle the claims, particularly against the directors. And that was something that came up again in the Officeserve case, where the judge was very keen to see the terms of the settlement agreement as against the directors for breach of duty, to make sure that there was no double recovery.
Yeah, so on this point, very briefly, and I'll try and avoid as much legal jargon as I can, but in essence, when you have cases involving tort claims where you may have defendants who are jointly liable in the proper sense, strictly speaking, and you have other claims where defendants are jointly and severally liable, and there's a legal difference between them. Where two people are jointly liable for a claim, there is only one cause of action. And so if you release the claim against one of them, the effect of that can be to destroy the entire cause of action, preventing you from suing the other person as well. And in those cases, therefore, you need, if you're settling with one, to have an express reservation of the right to sue. So you need to make it clear that you're not intending to release the other person, and you're not intending to release the cause of action. You're just simply settling with one of them. In cases where you have joint and several liability, there are two causes of action because there's several claims, but you can't have double recovery. And so there's a line of authority that says if you have a claim against A and a claim against B, and you settle with A, and the amount you recover from A is intended to be the full measure of your loss, even though it's not the full amount of your loss, then you can no longer sue B because that would be double recovery. So if you have a consent order with A, and that's interpreted as saying, well, you're treating that as the full amount that you've lost out on, you can inadvertently no longer be entitled to sue B. So again, you need careful drafting in those claims to make it clear in the settlement agreement that you're not intending to release the claims against B. And you might think, well, what's that got to do with 127 claims? And the trouble is that although these principles apply in tort cases, there's an authority which is referred to in the Officeserve case, which said it doesn't just apply to tort claims, it applies to other claims where you have situations which are closely analogous. And the takeaway point is that in Officeserve, what Judge Matthews said is whether or not a misfeasance claim against the director who's allowed a void disposition and a claim against the recipient of the disposition itself will be closely analogous will depend on whether the disposition was effectively a preference. So it was a payment that was used to pay debts. In that case, they won't be closely analogous because the company suffers no balance sheet loss. It's simply the unsecured creditors who are in a worse position. And so therefore you can merrily settle with one and not accidentally settle your claim against the other. But if there's no value for the payment, if it's a transaction undervalue or a gift, then the two situations are closely analogous because you're looking to recover what the company's lost. So the takeaway point is make sure when you've got potential claims against director and recipient that you don't inadvertently, by not having careful drafting your settlement agreement, end up releasing the claim against one when you don't want to. On that sort of scary bombshell, that brings us to the end of our slot. I do quickly need to just plug our forthcoming webinars. As I said at the start, this is the second in a series of autumn webinars we're putting on over the course of the next few weeks, taking us up to Christmas. The next one is taking place on the 9th of December next week, and Holly Doyle is going to be joined by Rachel Lay from Menzies. They're going to be looking at a subject which I'm sure is going to be of relevance to many people on this session, which is the standard of care owed by insolvency practitioners, and looking at the context in which IPs may find themselves on the wrong end of lawsuits and how to defend those. And then on the 17th of December, Sam Parsons is going to be joined by Debbie Grennan from our employment team, and they're going to be having a look at some issues arising with the interplay between employment law and insolvency, and things like CHUPI, pre-PAX, and pension issues and the like. And so look out in your inboxes for invites, which will no doubt be coming up in due course for that. That was the end of everything we proposed to say. I've noticed there's a couple of questions that have come in the chat function as we've gone along, so we'll do our best now to see if we can address those. Steve Hunt, I think, has come up with two questions. And firstly, he's asked, what's the normal approach to costs in 127? And has said that he had a recipient threaten personal costs against him if, as liquidator, he put in evidence opposing their retrospective application. And says, it seems to me a company ought never be visited with costs of a 127, let alone the liquidator, as there could be many applications in a single insolvency. I think the short answer that I would suggest to that, Steve, is that the error would be in trying to suggest that you were putting in evidence in opposition to the validation order, because the way I would approach it is the starting point is that Parliament has decided that this transaction is void, and you as liquidator are under an obligation to get in and realise the company's property. So you have a duty to take steps to try and recover the void disposition. If in the face of it the defendant says, well, I'm entitled to a validation order, then as liquidator I would say, well, that is a matter for the court. You need to persuade the court that you're entitled to one. I take an entirely neutral stance, of course, but I'm an officer of the court and it's my duty to draw to its attention the relevant case law and any facts that may mitigate against you getting an order. And I'm not going to be expressly saying to the court, don't make an order, but my counsel, through innuendo and heavy use of references to cases in the skeleton, will spell out to the judge how they dismiss the application, so that in the unlikely event a retrospective order is granted, you can say, well, I was completely neutral, and in fact they should have to pay our costs of the exercise of turning up to court to argue the toss on, not argue the toss, sorry, to take a neutral stance on this, because it was their failure to get a prospective order before the transaction was entered into that's necessitated the hearing. I mean, Ed, I don't know if there's anything there that you would disagree with.
I think the thing I'd observe is that was a case of a insolvency practitioner firm, and the recipient was an insolvency practitioner who had taken some of his his rem out of the company, or fees at the company, his consultancy fee, and therefore it was IP versus IP. So everyone was getting very handbags and had rights and everything else. But when it actually came down to it, everything backed off and died. But it was yeah, it was to do that. A lot of these are raised and dropped, I think, which is linked sort of to my second question.
Yeah, your second question is, isn't a retrospective validation application virtually impossible to win? I mean, I think these days, almost certainly yes, but of course Macclesfield shows us not quite, given that the chief judge was persuaded to grant an order. But it's true to say that if you work on the basis of Judge Cook's approach, which is you have to ask, with the benefit of hindsight, are the creditors better off today than they would have been because of this transaction? Then in most factual scenarios, if the company's ended up in winding up, then the creditors, there's going to be a depletion in the assets. But it's slightly unusual in the sense of, to an extent, the approach now being advocated almost sidesteps the wrongful trading jurisdiction, because you're really saying that you throw the liability at the door of anyone who's received monies from the company during the twilight period. So they may enter into a disposition, or transaction, which is in isolation to the benefit of the company. They may be paid 100 quid for assets the company sells for 200, but because the company has been trading wrongfully, and by the time of liquidation it's in a worse position, that recipient is told, sorry, you've got to bear the brunt of this loss, even though the probably proper approach would be for the liquidator to sue the directors who allowed the wrongful trading to take place, and that transaction to be blessed and retrospectively validated. Again, Ed, I don't know if you've got any other comments on that.
I suppose the other related question to that is whether it's better to make your application prospectively or retrospectively, because as Steve's kind of implied, is it more difficult to get it retrospectively? But clearly, if you're making your application retrospectively, the authorities say that the court can look at that with the benefit of hindsight and with the benefit of all of the evidence, and they can assess whether there has been a benefit to creditors. I mean, I've certainly been involved in prospective applications that have been successful, but in my mind those are just as hard, because you're trying to persuade the court about events in the future.
Yeah.
And clearly there might be a reluctance for the court to do that and disrupt the normal course. I mean, I think typically you might get that kind of validation order where, for example, there's clear evidence that, for example, the petition is frivolous, for example, and could clearly be dismissed. You can commonly persuade a court in that kind of scenario.
There is also, it's worth noting, isn't there? There's one potential get out of jail free card buried within the Express Electrical case, which is that Lord Justice Sales left open the possibility of some exceptional circumstance which would allow the court to validate a transaction that's not in the best interest of the creditors. And although he didn't give any concrete examples, he did hint at, if you've got a fraudulent director who has in fact positively encouraged someone to believe that everything's hunky-dory, and led them to enter into a disposition, and it goes above and beyond them having been merely careless and failed to check the advertisement and the register, but they've been positively led into a transaction they wouldn't otherwise have entered into, then you can see that there may be scope for a judge to say it'd be jolly unfair for them to have to pay this back, and you, Mr. Liquidator, need to sue the director instead. But I raise it that no more as a hypothetical possibility, and it all depends on the facts. And certainly in the 4 years since Express, we haven't had any cases hit the courts that have raised those sorts of facts.
So would you rule out the possibility? I know that's too strong. A liquidator presented with a void disposition. It's void. It's not voidable. It's void.
Yeah.
Could I, if I write to the other side and they articulate no defences whatsoever, just I'm not applying for validation, again relating to a recent case of mine involving IPs, could you issue a winding up petition, or is it a claim, not a debt?
The short answer, Steve, is yes, you can, and the reason is that although it may not be a debt as a common lawyer would understand the term debt, for the purposes of presenting a winding up petition, as contrasted with a bankruptcy petition, it doesn't need to be a liquidated debt. And so I think you probably would be able to persuade a judge that because the money has been avoided, your right to restitution doesn't depend upon you establishing anything before the court. It's the other way around. They've got to raise a defence to it.
Yes.
You would be able to present a petition. They would then obviously potentially be able to seek to defend it on the grounds there's a genuine and substantial dispute as to whether they get a validation order. But given you be in front of an ICC judge or an insolvency judge, they'd say, well, I'm as well placed as anyone to decide whether I would grant a validation order. And so if I wouldn't, there's no dispute, and therefore I can make a winding up order. Although presumably you'd want to not get quite up to the stage of order, you'd be doing that as the pressure to force them to then settle outside court.
You might hope. Well, thank you
Yeah.
very much. I thought that was a brilliant session. It was basically rehearsing what I've done a lot of 2020, really. So it was very interesting to me to see to check my notes. But thanks very much for that. I'll probably go through the recording again because it's very interesting.
Thanks, Steve. There's one other question that we haven't addressed, which is David Mond asked, how do you define debts as they fall due with COVID restrictions and a supplier allowing extended time? I don't know if you're still on, David, because it wasn't entirely clear to me from that question how that was phrased in the context of 127.
I saw him leave a little while ago and expressed his apologies.
In which case, perhaps if you want to ping us an email, David, once you've seen the recording of this, then we'll try and address that in due course. If anyone else has got any questions, we'll hang around for another 3 or 4 minutes. You can turn your mic on or you can put something in the chat function. But if not, then thank you everyone for attending. Enjoy the rest of your Thursday, and hopefully we'll see many of you on the 9th for Holly and Rachel's talk, which I'm sure will be excellent.